The International Monetary Fund has just issued a warning that shook Wall Street. Tech investments in the United States have reached their highest level in 25 years. This level of capital allocation hasn't been seen since the height of the 2001 bubble. Artificial intelligence is the epicenter of this unprecedented financial movement. The Global Financial Stability Report details a scenario of extreme optimism. Since the last semester, global financial conditions have become significantly looser. This has allowed capital to flow intensely into risk assets and tech stocks. The market is operating under the expectation of revolutionary gains. In the short term, this cash flow has generated record valuations in the markets. The S&P 500 and Nasdaq indices were driven by a handful of giant companies. The IMF highlights that this market concentration is one of the biggest risk points. If one of these firms fails to deliver profits, the entire system will feel the blow. The report points out that inflation is still a dangerous and persistent variable. While the market expects interest rate cuts, the IMF urges caution from central banks. If inflation doesn't converge to the target, rates will stay high for much longer. This higher for longer scenario is poison for tech valuations and growth. The report notes that credit spreads are at historically low and narrow levels. This indicates that investors are ignoring risk in exchange for any potential return. This market complacency is what worries the fund's economists the most right now. When risk is underestimated, any negative news triggers a violent market correction. Speaking of the future and the long-term, productivity via AI is still a promise. The IMF recognizes the potential for transformation but questions the payback time. Billions of dollars are being spent on infrastructure and high-performance chips, but the actual net profit from this technology has yet to appear solidly. There is an evident disconnect between stock prices and economic fundamentals. The IMF uses historical metrics to show that we are in potential bubble territory. The price-to-earnings ratio of leading companies is far above the historical average. In the long run, the economy always tends to return to its fundamental mean. Geopolitical tensions were also cited as a latent risk for the financial future. Disputes over semiconductors and supply chains could make technology more expensive. If hardware costs rise, the profit margins of AI companies will be crushed. Investors must consider the risk of global commercial and trade fragmentation. In the short term, abundant liquidity keeps the market in a state of euphoria. Companies are managing to refinance their debts with relative ease at this moment, but the IMF warns that this window of opportunity could close very suddenly. A shift in risk perception will cause capital to flee toward much safer assets. The U.S. commercial real estate sector is another weak link mentioned in the analysis. With high interest rates, many property owners are under extreme financial pressure. If a crisis hits this sector, the banks financing tech firms will be affected. The financial system is interconnected, and risk can migrate rapidly between sectors. The IMF recommends that investors not get carried away by technological FOMO. The fear of missing out on the next big thing blinds people to the real data. The report reinforces that financial discipline is vital during market peaks. Data shows that entering at the market top rarely brings good long-term returns. The fund's analysis suggests that global economic growth could be very uneven. While the U.S. attracts world capital, emerging countries lose vital liquidity. This strengthens the dollar, which ultimately hurts American exports abroad. It is a feedback loop that could generate currency instability in the long run. For the future, the sustainability of investments will depend on real results. It is not enough to just implement AI. It must generate actual cost savings. If companies do not reduce operational expenses, the current valuation will fall. The financial market will not accept empty promises for many more quarters. Volatility is at low levels, which the IMF classifies as dangerous tranquility. Historically, periods of low volatility precede major and sharp market drops. The prudent investor should use this moment to protect their personal wealth. Hedge strategies and diversification are essential according to the technical report. The IMF also focuses on the financial leverage of private investment funds. There is a lot of borrowed money sustaining large positions in tech companies. If the market turns, margin calls could accelerate the fall of stock prices. Transparency in these operations is still lower than what regulators would prefer. Monetary authorities face the challenge of not stifling economic growth. At the same time, they must prevent inflation from rising again with excess credit. The balance is delicate, and any miscalculation will have global consequences. The report makes it clear that a soft landing is still not guaranteed. In the long run, AI could indeed raise the potential GDP of the United States, but the path there will be marked by cycles of euphoria and severe corrections. Understanding that the market doesn't go up in a straight line is the first step. The data from 2001 serves as a stark reminder of what happens with excess. The capital allocated today in AI is the fuel for the next industrial revolution. However, the price paid for this fuel today might be too expensive for the return. The IMF insists on monitoring financial vulnerabilities across all sectors. Technology is the future, but the mathematics of interest rates dominates the present. Many companies are burning cash to secure a slice of the AI market share. This strategy works as long as investors are willing to inject new capital. If liquidity decreases, companies without real profit will be the first to vanish. This is a classic pattern observed in all previous technological bubbles. The report ends with a plea for solid international financial cooperation. Market fragmentation could lead to a generalized crisis of investor confidence. For the US investor, the focus must be on the quality of balance sheets. Avoid companies that rely solely on narratives to sustain their share price. Observe that the real interest rate in the US is at a restrictive level. This means that the cost of money is working against economic growth. If the stock market ignores this, it is betting against the logic of the Fed. The report highlights that this divergence is usually resolved with corrections.
Have you ever stopped to think that the videos you just watched with flawless scripts and engaging narrations might have been created by someone who never even touched a camera or a microphone? There is a new digital elite profiting heavily behind the scenes of YouTube and social media, building massive channels without ever showing their faces or spending thousands of dollars on equipment. While most people are frozen by the fear of being on camera, these individuals are using the hidden power of artificial intelligence to generate automated content that works and earns for them 24 hours a day. The secret to dominating this game isn't about having a famous face. It's about knowing how to command the right tools to create scripts, voices, and visuals that magnetically hold the audience's attention. I've gained access to a strategic method that reveals the exact roadmap for you to build your own invisible digital empire. Mastering AI to turn clicks into a real source of income. It is the perfect opportunity for those seeking financial and geographical freedom without having to deal with the pressure of being a public figure on the internet. Best of all, you can seize this opportunity right now for a symbolic price. The complete training is under an exclusive promotion, dropping from $97 to just $17. This is your passport to unlocking the knowledge you need to start your professional journey with AI today. Click the first link in the description to secure your spot while this discount is still active.
The short-term perspective is one of continued volatility in earnings reports. Each quarterly report from Big Tech will be a stress test for the entire market. Expectations are high, and any failure will be severely punished by algorithms. Be prepared for sharp swings in stock prices over the coming weeks and months. For the long term, the recommendation is to focus on sectors that actually use AI, not just those selling the picks and shovels of the gold rush, but the winners. Health and manufacturing companies that optimize processes will have real value. The IMF sees the potential, but warns that the current market is overloaded. Wealth concentration in the hands of a few players creates political risks to new regulations, and antitrust laws could emerge in the coming years in the US. This would directly affect the ability of these giants to dominate the market. Investors should monitor the legal landscape as much as the financial one. Financial history teaches us that optimism is the last stage before the fall. We aren't predicting a crash tomorrow, but risk indicators are at their peak. The IMF doesn't usually use strong terms without having solid statistical data. The chart comparing 2024 to 2001 is visual proof of this technical concern. Service inflation in the US remains a challenge for the Federal Reserve. This prevents interest rates from falling at the speed the stock market desires. The disconnect between stock optimism and the reality of rates is glaring. In the end, the bond market is usually more accurate than the stock market. If the bond market starts signaling a recession, tech will be hit the hardest. They are long duration assets, meaning their value depends on distant profits. The higher the interest rate, the lower the present value of those future profits. This is the golden rule of finance that the report makes sure to reinforce. The Global Financial Stability Report is a mandatory reading for professionals. It summarizes how capital is moving and where the traps are currently hidden. The message for the American public is one of caution, strategy, and realism. The future is promising, but entering that future requires emotional intelligence. The tech race is fascinating and will bring incredible advances to science. But as an investment, it must be treated with the coldness of numbers and data. The IMF has done its part to warn. Now it's up to the investor to decide. Knowledge is the best tool for navigating overheated and crowded markets. Analyze the data, check the rates, and don't ignore the history of 25 years ago. The economy is cyclical, and those who understand cycles can protect their future. The AI market is vast, but financial prudence is always the best path to take. Stay informed so you don't become the exit liquidity for the large hedge funds. We have reached the point where theory meets practice in your wallet and assets. Every investment decision must be based on facts and not on mass emotions. The IMF report is a technical guide for those seeking financial sobriety today. Time will tell if the market or the monetary fund was absolutely right. Do not forget that the financial market rewards patience and punishes haste. Risks persist. Opportunities do too. But balance is the key to everything. Understanding macroeconomics is understanding how the real world works. Always stay one step ahead by analyzing the reports that move the markets. The future perspective is one of an increasingly digital and integrated economy. Short-term challenges are interest rates, inflation, and excessive volatility. In the long run, the ability of companies to adapt will dictate who survives. The conscious investor focuses on resilience and sustainable value generation. The dollar will remain the reserve currency, but its strength will be tested. American public debt is another factor that the IMF monitors with attention. Large deficits could limit the government's ability to react to future crises. All of this makes up the complex scenario that today's investor must master. Big tech companies are now more powerful than many countries in capital terms. This strength attracts investment, but also the eyes of global regulators. The balance between innovation and regulation will be the theme of the decade. Stay tuned for the signals coming from Washington and also from Brussels. The flow of capital to AI could dry up if interest rates rise unexpectedly. Keep an opportunity reserved for moments of sharp market downturns. Buying quality assets at fair prices is the foundation of any solid fortune. The IMF report serves to remind you not to buy into the total euphoria. Technology has changed, but human behavior during bubbles remains the same. Greed and fear are the engines that create large price distortions. Recognizing these patterns is what differentiates the amateur from the pro. Study the past so you aren't surprised by the repetitions of the economic future. The coming months will be decisive for the consolidation of this market trend. Keep an eye on employment data and consumer price indices in the US. These numbers will dictate the pace of monetary policy and, therefore, stocks. Technical and fundamental analysis must go together in your strategy. AI's impact on the job market will also affect long-term consumption. If there is mass displacement of workers, consumption could be hit. This would generate a deflationary effect that would change all rate dynamics. The IMF looks at these macro variables with a 10 to 20-year vision. Financial stability is a fragile asset that requires constant maintenance. Financial institutions are more solid than in 2008, but new risks emerge. Today's risk is not subprime loans, but stretched valuations and tech leverage. Knowing where the risk is hidden is half the battle for any investor. The report shows us that the top can be a very lonely and dangerous place. With tech investment at its peak, the margin for error becomes tiny. Any disappointment will be amplified by the massive amount of capital at stake. Be cautious when others are greedy. As the famous Buffett proverb says, projections indicate that AI could add trillions to global GDP by 2030, but until then, many companies that shine today may no longer even exist. Focus on assets with real competitive advantages and proven cash flows. The IMF report is your shield against the irrational excitement of the moment. The American economy remains the most vibrant and innovative in the world. This gives it a competitive edge, but doesn't eliminate natural market cycles. Take advantage of the highs, but be prepared for the lows with the same intensity. Technical knowledge is what will give you the security to act in both scenarios. We hope this detailed analysis of the IMF report has been useful for you. Understanding the depth of the data is what puts you ahead of most players. The full report reveals that optimism should always be tempered with reality. Thank you for seeking quality information for your investment journey. The financial market is a marathon and not a 100-meter sprint. Each new piece of data is a kilometer traveled with more wisdom and awareness. AI is just one chapter in a much larger story about capital and progress. Keep your eyes on the fundamentals and your mind open to new changes. I want to know your honest opinion about the data presented by the IMF today. Do you believe we are in a tech bubble or that profit will justify the prices? Comment below your vision for the future of tech investments in the US. Don't forget to subscribe to the channel for the next technical analyses. Leave a like if this breakdown helped you better understand the current scenario. Your interaction is what moves us to bring the most relevant news in the world. Stay focused on the data, and we will see you soon for the next financial dive. Thank you for being here and for investing in your knowledge above all else.